Hopes the Fed can cut in September were boosted by Friday's PCE inflation data. All eyes are on US jobs figures later this week, and Japan's Tankan business survey out today may show us whether the Bank of Japan can hike again at the end of July. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior economist Birch explains why ANZ has lifted its Q2 inflation forecast.
From Q3, Australia's headline CPI is going to look a bit wacky. We're expecting that it'll drop from 3.9% in Q2 to 2.8% over the year in Q3. Now, that would put it within the RBA's target band. But this would be largely due to the temporary effects of various governments' cost of living measures.
But first, in 5 and 5 with ANZ, softer inflation data in the United States on Friday night has boosted hopes that the Federal Reserve can start cutting rates from September. The Fed's preferred PCE inflation measure was flat in May, up 2.6% annually. Core PCE, it was up only 0.1% for the month. That was as expected. ANZ head of G3 Economics, Brian Martin, says the 2.6% rise in annual core PCE was the lowest since March 2021.
That was supported by a very modest 0.1% rise in supercore inflation in the month. Supercore inflation measures services inflation excluding housing and accounts for nearly 50% of the PCE deflator. The 0.1% monthly rise in supercore inflation was the lowest increase in that component of inflation this year, and also the lowest since August last year. The data therefore supported expectations that the deflation process in the United States has resumed during the second quarter of this year.
As of 5 a.m. Sydney, Melbourne time, the Aussie dollar is at 66.7 US cents. That's up 0.4% from Friday, while the Kiwi is at 60.91 US cents, up 0.1%. Number 2. Brian says the FOMC will be watching for continued softening in price and jobs data over the next 2 months. He's expecting a 25 basis point cut in each of the FOMC meetings in September and December.
The June data calendar starts in earnest now next week. That should, I think, build confidence at the FOMC that the disinflation process is in place, and it would be appropriate to cut interest rates, probably at the September FOMC meeting.
Number 3. Markets will be watching out now for jobs and wages data in the United States later this week. ANZ senior rate strategist Jack Chambers says the FOMC will be looking for further signs of strain in the labour market.
That would kind of really cement the idea, as we expect, of a September rate cut from the US. If there are signs of strength, if there's particularly strong improvement in employment, particularly in the more market-sensitive sectors of the economy, so outside of the education and healthcare sectors, if we get signs of strength in those, it will probably be a sign or maybe challenge the idea that the Fed will be easing in Q3.
Number 4. Japan's Tankan business survey will be the focus later today for what it might signal to the Bank of Japan about economic activity. Jack says an improvement will lift confidence that the Bank of Japan can hike rates again in July to support the weak yen.
You have headwinds for Japanese businesses at the moment. Their import prices have increased significantly. And what we want to see is that starting to affect activity, or are there signs of the activity actually improving, which is what the Bank of Japan sort of wants to see. Any signs of weakness may drive markets to question whether the Bank of Japan actually will hike in July, because we know that their current plan is to essentially start quantitative tightening in July. There is a bit of a question, though, about whether they'll be willing to both hike and begin QT at the same meeting.
Number 5. Jack says European CPI figures this week will be an important indicator for the speed at which the European Central Bank can continue its easing cycle.
Focus there will be, are there any signs of any re-acceleration in inflation, or at least stabilisation at levels of inflation which are too high? What we've seen is activity in the euro area has been decelerating, which tells us that inflation should keep drifting lower. For the ECB, though, they just will want to see further progress on the disinflationary trend in order to justify a second cut in September.
Jack Chambers there. Now, in our bonus deep dive interview, ANZ senior economist Birch looks deeply into Australia's inflation outlook.
Following the May monthly CPI indicator release, we've lifted our headline CPI forecast for Q2 to 1.1%, and we've also marginally lifted our trimmed mean forecast to 0.9% as well. It is worth noting, though, that the monthly indicator doesn't exactly show what the quarterly CPI is going to do, and in Q2, that average quarterly growth in the monthly indicator does tend to overestimate growth in the quarterly headline CPI. But that would mean that we'd get annual headline inflation for Q2 at 3.9% and trimmed mean at 4%. So both of those would exceed the RBA's forecast of 3.8% for both measures. And if we did get a result like this, and we also saw the RBA revise up its expectations for things like activity and labour market data, there is a risk that the board could hike at the August meeting. It's not currently our call, but we'll be looking at things like the RBA minutes from the last meeting, which will be coming up on the 2nd of July, as well as things like labour market and retail data.
And then just looking out over the next few months, you expect that annual rate, I think, to come back down, but then pop up again in 2025. Just tell us what's driving both of those movements.
Yeah, from Q3, Australia's headline CPI is going to look a bit wacky. We're expecting that it'll drop from 3.9% in Q2 to 2.8% over the year in Q3. Now, that would put it within the RBA's target band. But this would be largely due to the temporary effects of various governments' cost of living measures, particularly the electricity rebates. And the RBA does tend to look through one-off impacts like these. And we also think that some of these measures won't actually have a material influence on trimmed mean inflation. So that is probably become a more watched measure of inflation over the next year or so. And we think that that will be coming down to around 3.4% by the end of this year. So not quite in the target band, but not too far away either. But on those cost of living measures, particularly the electricity rebates, we think that electricity prices could fall almost 30% in Q3, and that would subtract about 0.7 percentage points off the headline CPI. And that reflects some of the electricity rebates that we're seeing from governments, in particular the federal government giving $300 to every Australian household off their electricity bill. That will be in quarterly payments, so $75 each quarter for the 24-25 financial year. The Western Australian government will be paying $400 to every household in the state on top of that, and that will be in two $200 payments. And Queensland is going to have the biggest rebates with $1,000 off the electricity bill for all households in the state, and that will be paid up front in one payment from Q3. But the thing about these rebates is that if they're not extended over as the effects of these wane, we'll actually see that 0.7 percentage points that it will initially detract from headline CPI, that will be actually added back to the headline CPI. So by Q3 2025, we actually think that headline CPI is going to be back to the mid-threes, so jump back up as the effect of those rebates actually wanes. And again, this is where we think that trimmed mean is going to be more important to look at. That will give us a better idea of the underlying drivers that's not affected by some of these one-off measures. And we think that by then it will be back into the RBA's target band by mid-2025.
Catherine Birch there. Tomorrow in part 2 of the interview, Catherine will talk about the tough job getting services inflation down and how wage growth is affecting that. I'm Bernard Hickey. Thanks to Alex Tarrant for last week standing in. Had a great holiday. That was 5 and 5 with ANZ for Monday, July the 1st. Catch you tomorrow with a look ahead to the RBA's board minutes for June. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.